A warm greetings everyone. I am Shilpa. I welcome you all for my channel Chotu's Commerce Bus. Today I am here to discuss about some basic concepts of the taxation which will help commerce aspirants as well as others, those who are interested in learn the subject.
See, a tax may be defined as a compulsory extraction made by the central government from the general public. So that means a tax is not a voluntary payments or donations, but it is an enforced contribution to the government. It may be to the legislative authority. Who is legislative authority? Legislative authority, they have rights to make new laws or change existing laws. So they will collect tax from the public. They spend the collected amount for the common benefits of the society. What are the common benefits of the society? It may be free education or assistance for education, unemployment, birth of baby, medical expenses, or providing free ration, or constructing free hospitals. So these comes under free common benefits to the society. Likewise, our Indian taxation system is one of the world's largest taxation system in terms of its wide application on large number of people and business entities. It is well structured system and it is well derived from the Indian Constitution.
See, in introduction, tax is today an important source of revenue for the governments in all the countries, not only in India, in all the countries. It has become inevitable imposition because it has great potential for the raising of funds for meeting the development and defense needs of the nation. In other words, taxes on income, sale, purchase, and properties were collected to run government machineries. This this tax is further dividing into direct tax and indirect tax. So direct tax. This if a tax levied on the income or wealth of a person and it is paid by that person or his office, so directly to the government. That person is going to be paid directly to the government. So that is called direct tax. For example, income tax, wealth tax, capital gains tax, securities transactions tax, fringe benefits tax. This fringe benefits tax, before it was not there, this was introduced in the year 2005. And banking cash transactions, this is limited up to 50,000 rupees and above, that is also introduced in the year 2005. And in India, all direct taxes are levied and administered by the CBDT, that is Central Board of Direct Taxes. The second one is next, indirect tax. So this is also tax. It is levied on the goods and services of a person, or it may be a seller. It collected from the buyers and it's paid by the sellers. To whom they are paying? To the government. So for example, we can say that GST, goods and services tax. So indirect tax or the tax, if a tax is passed on by the taxpayers to some other person, it is called indirect tax. The examples, sales tax, value added tax. It is not directly paid by the person and whom it is levied, but it's paid indirectly through the medium of other person. Say example, I'm going to buy some machine or things from the shopkeeper. I will pay to the shopkeeper. The shopkeeper will pay to the government. So that is indirect tax. So income tax, it runs under Income Tax Act 1961. So income tax is a direct tax under which tax is calculated on the income or gains or profits which is earned by the person, such as individuals and other artificial entities. So other artificial entities in the sense, it may be a partnership firm or company. Any company it can be. And if we say additionally, Indian taxation system is one of the largest systems in the world. The authority to levy tax is derived from the Indian constitutions and it is well structured. we have well structured tax in India. The tax administration has clear demarcation between the capital of the government and or it may be central government and the state government, and then between the state governments and local bodies. So under the article 246, that is the seventh schedule of the Indian constitutions, contains the legislative powers, it may be including of the taxation of the union government and the state governments. See, if we see the history of income tax from where it is originating, it is introduced in the year 1857 itself. This is introduced by the Sir James Wilson. He became first finance member of India. So during that time itself, that is in the period of British rule. That too, it is introduced for temporarily, not for permanent. They have introduced for temporarily. In 1886, a separate IT Act was passed. Then first income tax is 1886. Since it is introduced in the 1857, the first income act passed in the year 1886. But currently in India, we are following Income Tax Act of 1961. Then this is brought into force the 1st April 1962. Then it applies to the whole India, including Jammu and Kashmir. Okay, it applies to the whole India. See, as I said, the income tax first introduced in India 1860 by British ruler Sir James Wilson, who became first Indian finance member in order to meet heavy expenses and losses suffered by the rulers due to India's first freedom movement. In the year 1857, the first freedom movement was there. So to reach that expenses, they were running out of money. So to reach that expenses, they have introduced this concept. It was introduced as a temporary revenue measure only for 5 years. They have introduced only for 5 years. The history of income tax in India can be divided into 3 periods. That is 3 periods. That is 1860 to 1885, 1886 to again 1914, 1914 to till now we are following same income tax act or same income tax rules and regulations. For the setup of income tax law in India, so what are the sources for setting these laws, income tax laws? What are the sources they are following? They following Income Tax Act 1961, Annual Finance Act, Income Tax Rules 1962, CBDT, that is Central Board of Direct Taxes, then judicial decisions. They are following all these guidelines, suggestions, rules and regulations to set up the income tax law in India.
So determination of residential status of an assessee. Who is assessee? Assessee, the person who pays the tax, is called an assessee. So how they determine the income? So they'll derive the income from all the 5 heads. What are the total 5 heads? That is income from salary, income from house property, income from profit or gain under business and profession, income from capital gain, and income from other sources. So section 14 of Income Tax Act 1961 provides for the computation of total income of an assessee, which is divided under these 5 heads of income. So each head of income has its own method of computation. So these 5 heads are income from salary, that deals with section 15 to 17, income from house property, that deals section 22 to 27, income from profit or gain under business and profession, that deals with 28 to 44, income from capital gain, that section deals with 45 to 55. At last, the income from other sources, so that is section 56 to 59. See, income from all these heads shall be computed separately according to the provisions given in this act. Which act? That is Income Tax Act 1961. Income computed under these heads shall be aggregated after adjusting the past and present classes of the total that is gross profit. So that total is known as gross profit. Then out of gross profit or gross total income, Income Tax Act 1961 allows certain deductions under the section 80. So after allowing these deductions, the figure which we arrive or which we get, so that is called total income, and on this figure tax liability is computed at the prescribed rates.
And there are two methods of paying the taxes by an assessee, that is step system and the slab system. But currently we are not following this, but we are going to follow this slab system. So we'll see that. The latest rate of income tax assessment year 2021 to 22. Just look into this. So what is income tax? The tax collected by the central government for each financial year on the total taxable income of an assessee earned during the previous year is called income tax.
Let us learn assessment year and the previous year. What is assessment year? An assessment year is a period of 12 months commencing from 1st April and ending 31st of March. It is a year in which the income of previous year is to be assessed. The current assessment year is 2022 to 23. An assessee, he will pay the tax for the period of 21 to 22. That is previous year. Previous year means the financial year immediately preceding the assessment year. Previous year is also known as accounting year or income year. So this question may ask in the exams. The current assessment year is 22 to 2023, which commenced on 1st April 2022 and will be end on 31st March 2023. The previous year for this assessment year would be 21 to 2022.
Who is that person? Under the section 2, subsection 31 says that on the Income Tax Act has given inclusive definition of a person as follows. The person includes an individual, a Hindu undivided family, a company, a firm, an association of person or body of individual, a local authority, and the every artificial and judicial person not included in the above. These are called person. This is Shilpa signing out until I meet you again in next video. Thank you for your kind support. Stay safe.